Hello, welcome to another edition of Nucleus Investment Insights. We are live here on a Thursday, 12:30. Today, I wanted to run through and talk about the reporting season. Now, I do want to highlight, look, we're right in the thick of it. A whole bunch of companies reporting last night, a lot of the Mag 7 included. So this is sort of, a lot of this is sort of hot off the press and still haven't had time to go through in heaps of detail. But there's certainly enough out there. I think it's well worth commenting on what's happening, and particularly as what we've really been pushing recently is this idea that in terms of markets, what's really important is the earnings holding up at this point. Valuations extended, particularly on the large cap stocks, and this huge AI boom ongoing. And so it's all about, can the earnings keep holding up? And what we've been seeing so far seems to be the case. But let's start with having it. Actually, I'll just quickly start with a disclaimer. Everything you hear today is general advice in nature, none of it's personal advice. If you are looking for personal advice, then you should be speaking to your personal advisor, or look in the show notes and you can grab our details. So I'm going to go through a whole bunch of different factors today. I want to talk about the Magnificent Seven in particular. I'm going to zone in on the capex spend because there's a lot going on in the capex and particularly announcements we've seen overnight. I think I've got to the bottom of sort of roughly what it is, but I think with a lot of this, I think there's, particularly for companies, as you see companies announce, all the good stuff is always quite clear as to what the good stuff is. It's digging in and working out where the bad stuff is can sometimes take a bit more time. But certainly the headlines are all pretty positive in terms of that the capex boom that's sort of ongoing. What I'll do just before I get into this is I just thought I'd actually have a quick focus on some of the quant factors that are working. And so just to put this in perspective, there's a whole bunch of different things you can use in terms of way you want to try and invest. Some people are sort of momentum, where what they're trying to do is just chase whatever's going up. That's what you want to buy. That's a lot of the traders tend to have a lot of those sort of momentum strategies. There's some other ones which sort of these idea that you just buy the cheapest stocks and that they're going to come good in eventually. Other ones about talking about growth and all these other different factors. And it's interesting sort of tracking through when you look at just those cohorts of companies and seeing what is performing from time to time. So I've got a chart which I'll pop up now, or a table just sort of talking about, say, the S&P 500, about what's been working. And the sector at the top is this style called volatility. And what it basically means is you look for the stocks that are the least volatile and you buy those. And they tend to be sort of more interest rate sensitive, but it's also this factor that it's a bit of a weird sector in that the stocks that are least volatile, in theory, should be the safest stocks, and they should be the ones that go up the least. But history shows that's not usually the case, and so they've really been leading the charge in terms of performance. Oh, sorry, and actually, just to put in perspective, what we're doing here is we're basically saying if we went and found the most volatile stocks and short sold those, and then bought the least volatile stocks, what would the return be? So sometimes when you look at these ones, the factor is the most volatile stocks are actually the ones that are underperforming the most, and I think that's certainly the true in terms of this volatility, in terms of volatility spread. At the other end, size. So, but basically that's saying buying small cap stocks. Been a terrible strategy for a number of years, and very much so in the last few months. That sort of the reporting season is sort of not encouraging, is showing that is still a factor, that the large cap stocks are the ones that are outperforming, and smaller stocks are not doing anywhere near as well. Also on that valuation and price momentum, they sort of make up the bottom three, and that's been a pretty consistent for all three of those right across the entire year. So the year to date, you sort of, if you'd done that strategy where you bought, say, in the price momentum, the stocks that are going, buying the stocks with the most price momentum and selling the ones with the least, you would have lost sort of 30%. So far this year, and size, just buying the largest ones and short selling the smallest ones would have got you almost 20% return. And so it's that, and that's that idea that so it's sort of digging into what's really been driving this is the more expensive stocks have been driving it, the larger stocks have been driving it, And the price momentum is that idea that, are you just tracking the trends and just holding on? And that's basically saying no, that they've actually had a really tough time of it in terms of price momentum, because the market's been so volatile. It's not just a matter of saying, yeah, I'll buy this and hold on. There has been, a fair few reversals and just sort of trying to track that price momentum. It's been quite difficult for those companies. Okay, so that's sort of what's sort of setting the scene for what's been working in terms of price movements. I want to dig into then the reporting season so far, and just looking at, can the earnings keep holding up? Because if the earnings, it's this thesis we've got that as long as we're seeing strong earnings, particularly from the AI sector, then we think the market does have some legs still within it, or there's a reason not to be completely out. If that turns, then that thesis goes away pretty quickly. So what I'm looking at here on screen is what the forecast profits are for across the S&P 500 for each of the different calendar years is the blue lines, and then the red line is the 12-month forward. So it's basically looking and using, so every day you use a little bit more of 2026 numbers and a little bit less of 2025 numbers. And when that red line is rising, markets will rise. And you can see that there was a bit of a wobble in that. It actually fell in around that Liberation Day in second quarter, and that sort of coincided with those markets coming off at that time. Last time we saw a meaningful downturn was back in 2022, and coincided very much with markets falling over that same time period. And that red line at the moment is got a pretty firm 45-degree up line. It's if anything, it's sort of been increasing a little bit recently. That's sort of the key line. The individual lines for individual years will almost always fall. It's sort of 2 or 3 years in 10 you might see rises in those numbers, but most of the time what happens is we get these forecasts for what's going to happen in 2026, and then that gradually reduces over time, and similar with 2025. And so how steep that line is, if it's just sort of a decline from saying, yeah, people were expecting say 10%, 11% growth, and then it comes back and it comes in at 7 or 8% growth, that's fine. That's a sort of typical year in terms of what you'd see. It's the ones where people start by expecting 10% growth and then it turns into -10. That's where you have these big down years. And so what we're seeing, 2025 numbers holding up. Not a lot of changes really have been to that for some time now. 2026 numbers are sort of gradually ticking up after being a fair bit lower, around that sort of Liberation Day concerns earlier on in the year. So, really not a lot of concerns on that profit front that we're seeing so far in this reporting season. If we jump to revenues, revenues are often a little bit lumpier, and so they can look a little bit more. Those step lines in as you're jumping from one period to the next, but again, there's sort of nothing really to be concerned about at all in terms of that, in terms of revenues. If you look at the just jumping back to this is actually the title of the overall slide is wrong. Actually, this is profits, just looking at quarter by quarter numbers. Again, nothing out of the ordinary in any of those quarters. Third quarter numbers ticking up a little bit, fourth quarter, very much holding strong so far, and that's really what you want to be seeing in the bad years. Even in the bad years, what you sometimes see is the third quarter numbers might be holding up, but you're seeing these big downgrades to fourth quarter numbers. So as companies report, they're like, yeah, we did all right in the third quarter, but fourth quarter is going to be way worse for whatever reasons. And so, no signs of that really at the moment, across the sort of aggregate companies. If I dig in a little bit and look at a different way, and this is sort of looking at global companies and just saying, well, where were we a month ago and where are we today? So a month ago was like 7.4% growth. Today it's 7% growth over the quarter. So it's a very slight downgrade, but nothing major. And what this chart's really showing is where have the declines been. So the Magnificent Seven, that's where most of the, you're getting, about almost a third of the growth. You're getting a third of that 7% is coming from the Magnificent Seven. We've seen the US excluding the Magnificent Seven get a bit weaker. and then the rest of the world get a little bit stronger, and in terms of forecasts. And so, net effect is really not a lot of change, sort of under the surface as well. And if you then you can then flip and then look at that in a different way, which is saying, if I took each sort of market segment and looked at how big it was of the market sector, and then looked at how much it's contributing to that sort of 7% growth, is actually financials is actually adding the most to this. So we've seen some really good numbers coming out of financial stocks. A lot of that's been trading revenue in particular, sort of the deal making and capital markets. But there's also been some pretty broad spread profits in wealth management, in insurance, some slight negatives in auto insurance. In particular, we saw JP Morgan talking about where you see one cockroach, there's usually more than one. I can't remember the exact phrase, but when if you start seeing cockroaches, that's probably not the last of them, and that they're seeing cockroaches in that auto sector. So something to keep an eye on. But overall financials, pretty much a ripping quarter, relative to where they've been over prior periods. IT and industrials also adding a fair bit to profits, and then on the negative side, you're looking at energy, communication services, and healthcare. And sorry, actually, when I say communication services, that's communication services x the Magnificent Seven, and healthcare are the sort of the weaker sectors which are detracting from growth there. Again, not a lot of change in any of those, and nothing really that surprising. So sort of fits with that theme that company earnings still look pretty good. I also wanted to throw in one more chart before we start digging into the next phase, which is really looking into this IT side and the capex boom. What are the concerns there, and what are we seeing coming out of this reporting season? So the thing about I just want to pull up a chart which is a little bit complicated in terms of the construction of it, but it's quite indicative, I think, of what's going on at the moment. Is we've got this red line and a blue line on this chart, and the blue line is effectively showing the corporate free cash flow, so profits in excess of net investment, and that's sitting very high as a percentage of GDP, and much higher than it has been over the last sort of 70 or 80 years, however long this chart goes for. The red line is then the deficit of US governments, households, and foreign trading partners. So that's their sort of income in excess of consumption and net investment. And really what it's showing is that these are two sides of the same coin. Is that when you're seeing big government deficits, that's going to end up in another sector of the economy. And typically the sector that ends up in is corporate profits. And so we're seeing these big government deficits being run. We're seeing high corporate profits. If we start thinking that those deficits are going to come down, if Elon reappears as a Doge with his chainsaw, and this time they mean it, then you can actually start talking about saying, okay, well, is there some threats to profits? But really, with the US government, firmly spending lots of money and also seeing that they're decreasing regulations and things like that. Yes, there's an argument that at some point this thing will mean revert, but I think it's hard to say that that's coming anytime soon. And so, one more reason that the idea that we're looking at quite a strong profit season and no real, while there's lots to be concerned about and lots of, from a conceptual point of view, there's really no signs of weakness at the aggregate level yet. And so, I'll jump to a quick message, and then we will come back and talk about the AI expenditure in particular and what we're seeing coming out of that from this reporting season.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right. So we've spoken a little bit, well, certainly a lot over the recent times in terms of saying, okay, so we've got sort of two parts of the market. You've got the AI part of the market, the non-AI part of the market. The non-AI part of the market is pretty fairly valued. It's sort of a little slightly above average, but pretty much in line with sort of longer term averages. The AI part of the market is expensive, and the AI part of the market is the largest part, and then they are the biggest stocks, and so that's what drags all these averages up when we look at sort of the overall averages for markets. Okay, so the question we're asking is it worth paying extra for these AI stocks because they've got higher growth than the rest of the market? And then how much extra? So what's priced in at the moment is sort of probably getting close to about 11, 12% extra growth per annum out of these stocks for the next 10 years. Now that's starting to get high, but it's certainly still in the realms of possibility. And so the question is, and it's probably more about saying, look, is the rest of the market going to be weak? Because if the rest of the market's going to be doing 0% growth per annum for a long period of time, or say low, let's say it's going to be doing 2 or 3% growth, can the AI part of the market do 15? Yeah, sure, that sounds more reasonable. If you're going to see a boom in the rest of the market and you're going to get sort of 10% growth from the rest of the market, does that mean you're going to get sort of 22 to 25% growth in AI per annum for 10 years? That sounds like more of a stretch. So anyway, the focus though really is on this whole, what's really holding this market together is this capex spending on AI. And if we start seeing cracks in that, is when we need to start being concerned. We're not really seeing too many cracks at the moment. Let's jump to a quick slide, just sort of showing this is sort of the last 12 months, and it actually doesn't include some of the announced spending we've just seen. So the announced spending still remains strong in all these stocks. It's using just these sort of top 5 stocks, and it's looking at sort of over 300 billion, for the last 12 months, and that's rising over the time. There's Microsoft itself is looking at spending 100 million, Amazon as well, in terms of how they're how much they're looking at these data centers. So there's still growth is big. The companies are all still talking about being very profitable and making lots of money from it. So that part doesn't seem a problem. We have spoken as well in the past about saying, how much of this is sort of is the snake eating its own tail? Like how much of this is that they're all selling stuff to each other, and so our sort of rough numbers is about 2/3 of this market, 2/3 of the spending on AI is either these big companies themselves spending the AI, or the unprofitable open AIs and the startups spending that money. And then about 1/3 of it, maybe somewhere between a third and say 40% of it is sort of real world applications in terms of other companies that are spending money in order to say healthcare companies or military spending money to try and improve their own use of AI. So when I look at these numbers, really not a lot there's really doesn't seem to be any real slowing down within these numbers. If how big is this? This is as a proportion of GDP, it's probably about 1% ish of US GDP. So meaningful. We're only talking about 5 companies here. If you spread that out and you say, well, let's have a look at all spending across these, and saying, if we're in this, if we're going into a bubble, how far are we into this bubble, and are we at the sort of peak, and we have to worry about the whole thing imploding, or are we still climbing is the bubble still getting bigger? And the indications, I've got a chart up just sort of showing the tech investment over the last sort of 70 or 80 years, and growing from sort of 1% ish of GDP in the 1950s and 60s, up to sort of peaking at 4% in the tech boom. Keeping in mind as well, there was a lot of that spend was also year 2000 bug, sort of came around that same time. So there was a bit of that extra spending probably was based around that. So we're back to that sort of back pretty close to that peak at over 4% of GDP. So so certainly high. You could there's probably is an argument you could make to say, or some people are making arguments saying, oh look, we're back to the same levels we were in the tech boom, and so therefore we must be at the peak. I think that's probably slightly disingenuous in that tech spending over time is increasing, and what we've seen just as a total of your total economy. So we're 25 years on from where we were. There's a reasonable amount of tech spending, say in farm equipment, that you just didn't have 30 years ago. It was all sort of talking about, when you're talking about the spending on farming, 25, 30 years ago was all about mechanical sort of things. Yes, we're buying new tractors and all that type of stuff like that, and they might have more in them, but it was sort of classified as a mechanical spend. Whereas if you're out there today buying drones that fly over and look at the moisture levels in your soil and things like that, that sort of gets classified more is much more likely to be classified in the tech spending side of it. And so there is this sort of this gradual increase for the whole economy to be spending more money on tech and less on other industries. And so I think the peak is probably higher than where we are at the moment. And you put, I guess, as a reference point as well, not to say this is, just because this is a number that exists, that's where it needs to reach. But, if you're talking about, say, the railroad boom, that sort of reached about 6% of US GDP as a percentage of GDP in terms of that capex boom within that. And that actually, and also a number of years above 4%. So that was sort of a much more prolonged in terms of that. And so, I think there's a... is there an argument that we're in a bubble and it's too high and it'll have to come down? Maybe. Is there an argument that there's no possible way that we can spend any more money in this? It's reaching its maximum. Is like no. They, you could easily add. If, let's say you went to 6% of GDP, which is sort of similar to the railroad boom. Well, that's going to add 50% to current spending. So I'm not saying that's going to necessarily happen, but I think there's a lot of scope between here and that to for that capex to grow. Certainly, the company announcements that we're seeing have been based around saying that there's still more spending to come, really not slowing down in any meaningful way through their own choice. So I think there's parts where it's like, yes, we can't get the power, or we can't get the parts, or we can't get the chips we need, or whatever it is. But there's no sort of real, the economics don't add up anymore, and so we're starting to slow down on the production of these. If we look at some of these stocks, what they're spending as a proportion of their revenues, so look, it's high, but it's not sort of unheard of in terms of the heights of it. I think where you're looking at sort of 10 to 20% for most of the big stocks. The outlier there is Oracle, and so that's probably that's a couple of things with this. So let me I'll come back to Oracle in a second. Let's talk about the other companies. The other companies, they're still spending out of free cash flow, so they're not going into debt to do this. It's not something where from a big picture perspective, the bubbles you get really concerned about are the ones where it's all debt driven and leverage driven and with options and all these other types of things like that. So this one is, or the tech boom, I think, even though it wasn't really debt driven, it was certainly driven by a lot of capital raisings. There was a lot of money going in, a lot of new IPOs and everything going into the market that was creating this new money that would then get spent on all these other sectors. What we're really seeing at the moment still for these big companies is just reinvesting of the profits they're already making. So much less concerning from that perspective, and also a sign that it can go considerably higher. That isn't the case for Oracle. Having said that, this line I think overstates it in that this is looking at the historical earnings for Oracle. Oracle's spending is really based upon it's sort of increasing its revenues in that data center sector by 10 times. It's literally adding a zero, over the next few years to the to its earnings on that front. And so and so I'm pretty sure sales as well. And so that this number because it is looking at a number that doesn't, it's looking at the amount of capex they're out there spending relative to the amount of money they made last year. But, if you actually look a bit more forward, it doesn't look as bad. Having said that, Oracle's certainly one area where I'd say it's at the pointy end of the boom. Okay, so the capex side looks fine. There's been a few things out in terms of companies reporting some pretty big job losses and layoffs. And this one's always a hard one to get a grip on. So when you talk about layoffs and announced layoffs, the question about how many of those actually flow through, are they being announced? But I think Amazon was sort of like 14,000 or something like that. But I think a lot of them were part-time jobs, so it's hard to tell how that actually relates back to full-timers. You often get some big disconnects between what gets announced and then what actually gets done. So there is a survey out there called the Challenger survey that tries to track this, and it tracks the announcements. Now, it only reports monthly, and so we have seen a fair few of these announcements come out, so we haven't got all of that through just yet. But it's not sort of at any level you'd sort of call particularly concerning at the moment. Anecdotally, you can look through and you can get these long lists of companies that have all done these massive announcements. But I'm just sort of looking at this chart now, and the September numbers, which are at basically the same level they've been at for the past 5 years. They're sort of sitting in the middle of the band. We can see this massive spike up earlier on in the year, which was a lot of the Doge announced cuts. Having said that, I think a lot of the Doge announced cuts then actually ended up being rehiring the same people, and so it gets treated as a job loss and then a job gain, and so certainly messing up some of those numbers. But big picture wise, one of the negatives you might take out of this reporting season is the job layoffs. I guess what I'm trying to say there is it's hard to rate that back to actually saying there's the actual levels of those job numbers don't seem concerning just yet. The overall, thought that people will be losing jobs and that's going to be, corporates are going to be making out well. And meanwhile, we're going to see job layoffs, which is going to be increasing the pressure for the rest of the economy. And this idea of stagflation that we're sort of seeing both in Australia and the US of higher jobs, higher unemployment and higher inflation is a concern. But I guess we need to wait to see more information on that. Okay, so that's sort of a broad picture of where we're going with the reporting season. I'm just going to go to another quick sales message and then come back and talk about the investment implications and what this really means.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now, direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Okay, so investment implications. So where do we go from with this new knowledge? So I think it's a pretty good case for staying the course. Is that we're looking to try and keep exposure to the AI boom. We've got a little bit of exposure at the sort of real pointy end of it, the less profitable stuff. Most of our exposure though really lies in the big stocks that are making money and generating real revenues from this. And when I say real, with a national disclaimer, some of it is passing a bit circular, passing between each other, but there is sort of real money flowing in eventually into this sector. They're making more than they're spending. As a sector whole, they're making more than they're spending. Okay, so that's one part of it. The real part, though, that I wanted to talk about, and let me just bring up a chart, is this idea about how much are we paying for stocks that are part of the AI versus how much we're paying the AI sector versus stocks that are not. So I'm just showing these charts, and I've got two different charts. The top one is the 12-month forward earnings, and the second one is the 24-month forward earnings. So we're looking at what's expected to come, and it's broken it out into the biggest 2% of stocks, the next sort of 2 to 20, the middle 60%, and the smallest 20%. And this is of the 1,500 stocks globally. So it's most of the stocks. It's like 80% of all stock markets, all listed stock markets fall into this. And so I'll focus on the bottom three lines at the moment. So the biggest sort of all the stocks from 2 to 20%, the middle 60, and the smallest 20. All those lines are really around about average. If you want to quibble, some of them are slightly above their longer term average, but really there's not a lot of difference where they are now to where they have traded over that past sort of 25 odd years. So you can buy those stocks at average multiples. Then we've got the blue line at the top, which is this biggest 2%. Now, the 12-month forward earnings now are over 30%. The 24-month, that's sort of factoring in the expectation for higher growth from some of those. So if you strip that out and you sort of look a little bit further out, you're like, well, okay, now it's back to 25. So yes, you're paying a lot for next year's earnings, but actually these stocks are expected to grow at sort of 20% plus, and that brings back their the earnings to something much more reasonable in the following year. Sorry, maybe much more reasonable, considerably more reasonable. It's still expensive. I won't quibble around that. You're still paying a significant amount for those stocks. But if you can add another year of 20% growth onto that, now you're sort of back under 20, and it's this question about how many years can you get of this extreme growth from this sector. And so what we've really been doing is taking the view that, look, we don't know how long it's going to go for. We can certainly see reasons why you might want to pull back on this sector, and you might say that, hey, things are too expensive, I need to pull out. But at the same time, we keep seeing this growth coming through. And so what we're sort of doing is effectively dancing near the door somewhere, as we're saying, look, let's stick with this. The boom could get a lot bigger than what we're seeing at the moment. We can see reasons why. We don't know for sure it will, but we can see enough growth coming through and enough solid earnings coming through that it really just is worth, in our view, sticking with this expectation. We hold with it and just looking for signs as much as we can, which is effectively why I'm doing this podcast. Just digging into these signs. Is the AI boom ending? Are we seeing problems on the earnings front? Two biggest factors that sort of lead us to reverse that to date. Really just not a lot of signs at all from this reporting season that we're seeing anything like that. So the Magnificent Seven, most of those or a bunch of those came out overnight. Earnings looking strong, AI looking strong, capex in the data center still looking strong, margins are still really high, valuations, as I said, we've spoken a little bit about that, and so it really just comes back to that dichotomy. Do you want to either go out and buy non-AI stocks at normal prices, or do you want to buy the AI stocks at extended valuations but with much higher growth? And we're opting for a mix of both, and particularly sort of within the stocks that aren't in AI, we're sort of looking for the ones we think will hold up better if there is sort of more weakness and sort of more of a stagflationary type of environment. I think I will leave it at that. Just want to thank everyone for listening in. It's been relatively quiet on the questions front, but just to highlight that you can jump in and ask any questions if you want. We've got all the different places you can get this in terms of all the different podcast platforms, different social medias you can catch us on as well. Feel free to drop in some comments. I'll love to see what everyone's saying, and we will see everyone next week. Thank you very much.